Hey folks, welcome to Chapter 16, Mastering Financial Management. This will be our last chapter in the Foundations of Business book, and we will be moving on to information systems. And so I wanted to make sure this week we paired accounting and finance together, 15 and 16, because they do go hand in hand. And so, let's get started. So the need for financial management. First of all, financial management in itself is the activities concerned with obtaining money and using it effectively. One of the things you will find in business is that without money, without capital, without cash, a company just cannot exist. I know throughout this course I've talked about how I believe human resources are the greatest resource. It's true, but also you have to have cash, you have to have available capital, and you have to establish good credit practices to make sure that you can have access to money. And so, here's what proper financial management must ensure: that funds are available when needed, both now and in the future. Okay, however and that it's obtained at the least cost as possible, at the lowest cost possible. So now we're talking interest rates potentially on borrowing. Financing priorities are established with the company goals. Okay, those go hand in hand. Spending is planned and controlled. That's what budgets do. They make sure that spending is planned and controlled. A firm's credit customers pay their bills on time, and that as a company, you pay your bills on time to maintain a good credit rating so that cash is cheaper for you. That funds required for paying the firm's taxes are available when needed to meet tax deadlines, because nothing's worse than having the government come in and say you owe taxes and you don't have the money to pay it. That's not good. And then that excess cash is then invested, whether it's in CDs, government securities, or conservative marketable securities. Careers in finance. Here are the different types of finance positions within different companies. You've got your CFO, your vice president of finance, banking officers, credit analysts or credit officers, financial analysts, financial planners, loan officers, insurance analysts, as well as investment account executives. Managers and employees in finance areas must have a strong background in finance and accounting. No Excel. One of the most important things that I see more companies asking for are extensive Excel skills. So being able to utilize Excel is important, and then be an expert in written and oral communication. Short-term and long-term financing. Basically, short-term financing needs typically revolves around cash flow problems, current inventory needs, short-term promotional needs, speculative production, monthly expenses, and unexpected emergencies. Business startup costs are more geared towards long-term financing needs, new product development, replacement of equipment, M&A, mergers and acquisitions, long-term marketing activities, and expansion of facilities. Short and long-term financing, basically the general definition is short-term financing, that's money that will be used for 1 year or less, and long-term financing, money that will be used for longer than 1 year. The risk-return ratio, when it comes to investing, basically when we talked about the risk ratio and information, the more timely, better information you have, the less of the risk. This risk-return ratio is basically a ratio based on the principle that a high-risk decision should yield a greater financial return for a business, and a more conservative decision, often generates lower returns. So if I'm young and I want to invest and I have money to lose potentially, I might risk something along the lines of cryptocurrency, or I might invest in an international or a foreign company. Whereas if I'm older, I really can't afford the risk, I'm probably going to, invest in mutual funds. Same thing with companies. They have to understand how much money they have and then what they're willing to risk. Excuse me. The 3 steps of financial planning. Basically, step 1 is establishing the organizational goals. Remember, all your financing is tied to those goals. setting the budget, right? Budget the money needed to accomplish the goals, and then identify the sources of funds. Sales revenues, that's a source of fund. Equity capital, that's again owner's equity, selling stock. Debt capital, whether that's short-term borrowing or long-term borrowing, and then sale of assets. So if I have a piece of equipment that's that I'm no longer using, it's outlived its usefulness for me, I can turn around and sell that asset and then recognize the cash. So people do that. Okay, so different ways of obtaining funds. Here's an example of a cash budget. So in the first quarter, you can see, I'm going to move this here. First quarter, you can see, cash sales. Here are all the cash sales in the first, second, third quarter total. Here are less payments. So we purchased, we have our wages, we have our rents, our other expenses, our taxes. Our total payments exceed our cash sales and collections. And so we have a cash loss. Our second quarter, you can see we have more cash, more sales than we do total payments, and so on and so on. And so it's important to keep a cash budget to know exactly how liquid, we talked about that in chapter 15, how liquid you are, how much cash you have available on hand. Here's an interesting tidbit I just want to throw in this. Credit card transactions are important, so understanding what those transactions look like for business. But just in general, a recent Gallup poll found that 3 out of 4 Americans, 76% of all Americans have at least one credit card. And on average, Americans have at least 3.4 credit cards. And then half Americans, 48%, are carrying debt, credit card debt, from one month to the next because they don't pay their entire credit card debt each month. So Americans in general are what we call over leveraged. We are carrying too much debt as a country. And so much of that is in credit cards, and some people wind up having to live through credit card debt. And so from 2008, when we had the Great Recession, through COVID, through now, people had to live off their credit cards and having difficulty paying it back. And so that's real. That's reality. And so it's just something to be aware of from a personal standpoint as well as a professional standpoint. Sources of unsecured short-term financing. Basically, short-term debt financing is usually easier to obtain than long-term. Most lenders don't require collateral for short-term financing. The reason it's easier to get is because the money that you're borrowing is typically a lot less than a long-term debt. Typically, you borrow from your bank, which hopefully you have a relationship with your banker. The interest rates are, you're still going to make interest rate money off the interest if you're a bank. And so the risk to a bank lending somebody a smaller amount of time for a shorter period of time is usually a lot easier. And it's unsecured because there's no collateral. I just go in as a business owner and saying, hey, I need a short-term loan to cover payroll this month, and I'll pay it back, in 3 months. And so there's no security, there's no collateral. They lend it to me at an interest rate. I pay my bills, or I pay my salaries to my employees, and then 3 months later I pay back the loan. Not a big deal. A lot of times those, if they are secured, they're secured through inventory. If I'm a company that makes, Taylor guitars, if I make guitars, I need to borrow money, I can secure the loan against all of my inventory because my inventory has value. Or if companies owe me money in the form of receivables, I can use that money or those receivables to also secure the loan. If I say, okay, I've got over $1 million in outstanding receivables with terms of payment within 30 days, I need to borrow money until I get that money. Can I borrow money based on the receivables I have? And most banks will agree to that. Okay, those are the difference between unsecured and secured short-term financing. Remember, short-term is less than a year. We're going to talk a little bit about selling stock within corporations. We talked a little bit about common stock versus preferred stock, but selling stock, that's another way for a corporation, a public corporation particularly, to generate cash, generate money. And so an IPO occurs when I'm sure you've all heard of IPOs. It occurs when corporations sell common stock to the general public for the first time. When a corporation uses an IPO to raise capital, the stock is sold in the primary market. Okay, the primary market is a market in which an investor purchases financial securities via an investment bank directly from the issuer of that security. And then investment banking firms, those are typically organizations that assist corporations in raising funds. Basically, that's what those are. Initial public offerings in primary market continued. So advantages of selling stock, no repayment obligation for the company, and no dividend requirement. So if I'm a corporation and I sell stock, yes, I'm selling stock, but I don't have to repay that back. You own a portion of my company. I still have total control of the company. You've given me money to invest in that. And then you're only making money if you sell that stock, but I don't have to pay you back. Okay? I don't have to pay you back at all. That's free money for me, basically. The secondary market, that's a market for existing financial securities that are traded between investors. Think of the NYSE, the New York Stock Exchange, and the NASDAQ. Okay? Venture capital, angel investors, this is another place to get short-term. Think Shark Tank. If you've ever watched Shark Tank, those are angel investors. Those are people that come in and for a portion of the ownership of the company without any say-so in management, they will come in and they will give you money. Okay? Venture capital group, same thing, money invested in small, sometimes struggling firms that have potential to become successful. And then private placement, that occurs when stock and other corporate securities are sold directly to insurance companies, pension funds, and large institutional investors, typically for mutual funds. Sources of long-term debt financing, this is leverage. This is when you look on the balance sheet, typically, you're going to see the liabilities. Financial leverage is liabilities. And at this point, just about everybody is over leveraged because, interest rates are where people will borrow money, and they have been for a while. And so financial leverage is basically the use of borrowed funds to increase the return on owner's equity. The principle of financial leverage works as long as a firm's earnings are larger than the interest charged. So if I make more money borrowing that money, if I make more money using that money than the interest that I have to pay back, then it's worth it. Okay? For small businesses, long-term debt financing is generally limited to loans, whereas large corporations have additional options of issuing corporate bonds. So a corporate bond, we'll talk about in a second, but long-term loan agreements, typically a promissory note, typically they want collateral. And so lenders may require borrowers maintain a minimum amount of working capital, and the lender, again, usually requires some type of collateral. So those are long-term loan agreements. You sign a promissory note that requires a borrower to repay the loan monthly, quarterly, or semi-annually. So corporate bonds, just like U.S. bonds, Treasury notes, a corporate bond is a corporation's written pledge that it will repay a specific amount of money with interest. Okay, so if I buy a $100 corporate bond from General Electric, they're guaranteeing to me in 10 years, if it's a 10-year bond, they'll give me my money back plus interest. Okay, and so a lot of times corporate bonds are much more secure than U.S. Treasury notes or Treasury bonds because corporations typically are doing a lot better than the actual federal government. Most corporate bonds are registered bonds, so a bond registered in the owner's name by the issuing company, and there's a maturity date. That's the maturity date. Give me $100, and then 10 years, I'll give you $100 back plus interest, whatever that interest is. Okay? Now, here's the thing. The risk-return ratio. If the bond is a really highly secured bond, like a GE bond, the interest rate's going to be lower. So if I give GE $100, that bond may only be worth 5% interest rate at the end. Where if it's a really risky bond, like a small a startup or a company that's maybe going has some leverage issues or finance issues, they're going to have to pay me more money at the end. My risk is great enough to where you're going to have to give me a higher interest rate in order for me to give you that money for the bond. And so same thing, risk, the more I should make. The less risk, the less I'm going to make. Okay? And I believe that's it. That's it for financing. That's it for our Foundations of Business book. I hope you all learned a lot there. We're going to continue to work together through these next few weeks, whether it be in information systems or in Excel. And so I hope you enjoyed this part of the class, and we will talk to you soon.